What if I told you you could make any stock a dividend stock, even if it doesn't pay dividends? Dividend-esque. Technically, this isn't a real dividend because dividends come from companies paying profits to shareholders. But by using the strategy we'll cover today, selling covered calls, you can generate income from stock that you already own. Now, let me be clear up front. There's no such thing as a free lunch in investing. This strategy is not perfect. There are risks and there are trade-offs. But in the right situations, it can be a great way to generate income from your stocks. And I'll break all that down and show you exactly how I'm using this strategy today. That's right. Instead of just bloviating about a strategy that I wouldn't myself follow, I'm actually selling covered calls today on my Palantir stock. That makes us different than other finance channels that just talk theory. I put my own money behind these strategies. Speaking of which, if this is your first time joining us, please consider giving us a like and subscribe. We're on a mission to bring intelligent investing into the mainstream. And by liking and subscribing to this video, you'll help us get this message out to more people. And if you want to learn more about what we're all about at Flank Investing, there'll be a link to our site in the description below, as well as a link to our free Discord. I hope to see you over there. All right, let's cut right to the chase. I'm going to keep this discussion solely focused on selling covered calls. If you're new to options and want a broader breakdown, check out our options trading video that featured Nancy Pelosi's trade. We'll make sure to link it at the end. But a call option is a contract that gives the buyer the right, but not the obligation, to buy a stock from you at a set price, also known as the strike price, before a certain date, also known as the expiration. And since I'm the one selling the call option, the buyer will be paying me a premium for this contract. That's where the dividend, or more appropriately, the derivative income, comes in. Now, if the stock price stays below that strike price, the option will expire worthless, and I get to keep my shares and the premium, which is basically free money like a dividend. But if the stock rises above the strike price and then the buyer exercises that option, which most of the time they will, then they get to buy my stock at that agreed upon price. I'll still keep the premium, but my shares will be gone. If that was a little confusing, don't worry, it'll make more sense when I actually show you how I'm doing this. But first, let's talk about the risks. So what are the risks of this strategy? Well, first, there's the capped upside. If the stock skyrockets, then I'll miss out on those huge gains because I've already agreed to sell my stock at the strike price. And then second, I must be willing to sell. If the option is exercised, I'll lose my shares. So I wouldn't do this to any stock that you're emotionally attached to. And you also shouldn't be emotionally attached to stocks. And then there's no downside protection. If the stock drops hard, my only cushion will be the premium, which does soften the blow a little bit. But otherwise, I'm taking the same losses as if I just held the stock, which is okay in my case with Palantir. I've owned it since 2021, and I've seen the stock get cut in half, but my thesis prevailed, which is exactly how you should invest. And then finally, and I cannot stress this enough, naked calls are a disaster. Always make sure you're selling covered calls, meaning that you actually own the stock. Selling a naked call where you don't own the shares is a way riskier strategy that I in no way recommend, because if that stock does run up, then you'll have to buy shares at the market price and sell them to the buyer, potentially at a huge loss. Again, never sell a naked call. So why am I doing this strategy? When does this strategy make sense? The strategy works best when you think a stock will trade sideways or rise slightly. And then again, if you're okay with selling at a set price. For me, I think Palantir has run up a little too fast, and the hype is back in full force. And so I think people will be willing to pay me nicely for the premium on these call options. And then one more thing before we move on. Let me be very clear. I am not telling you to buy options. In fact, options trading is one of the biggest grifts modern day brokerages have fooled us as individual investors into giving them more money. In fact, it's the number one way Robinhood makes money off of us. And people don't really understand what they're doing. It's making the markets more of a casino than as an actual way to get rich. But in this case, I'm on the opposite side of the trade. I'm the one selling the option. And I'll happily take the premium because I'm looking to get out of my Palantir spot. And I think people are going to continue to be really speculative on this stock. All right, let me walk you through how I'm doing this with my own Palantir shares. But while I'm queuing that up, here's Buffett on why you shouldn't buy options.
I think there was one time we sold a put on Coca-Cola with the idea that if it got exercised, we were very happy to own more Coca-Cola. It didn't get exercised. We would have been better off if we just bought the stock. Usually, if you want to buy or sell a stock, you should buy or sell the stock. And using an option technique to buy a call on a stock instead of buying the stock outright with the idea that you get it a little cheaper that way means that about 4 times out of 5 you'll be right, and the 5th time the stock will have moved earlier, and you'll have missed the transaction you wanted to have. And so we virtually have never used options as a way to enter a position or exit a position, and I would doubt very much if we do. We've sold these long-term equity put options that are described in the press release yesterday and were described in the annual report, but that's a different sort of thing. If we want to buy something, we'll just start buying it, and if we want to get out of it, we'll start selling it, and we won't get involved in any fancy techniques.
Okay, so here we have me in my Fidelity account. So as I'm going through this view, it's called the options chain. You can see that as I'm setting the expiration date, so this would be this Friday, and then the strike price, say $100. If I sold this, I would get 75 cents for writing that contract. And this is really important. In options, one stock is equal to 100 shares. So you multiply these numbers by 100. So I'd get $75 per contract that I write at this level. And then on a longer expiration date, for instance, if we go to April 17th, right before they report earnings, you can see that that's a lot higher. That would be $565 per contract that I wrote. And so when I'm doing this, I shop around with different expiration dates and different strike prices just to see where I can get the best deal. And you can see Fidelity gives you a probability of it being out of the money, which is what we want. Ideally, I'd like to retain my shares so I can continue to do this. And so after doing a little bit of shopping around, I think I'm going to do this. This is March 14th, 2025. A $95 strike price, and the bid is $4.25. And in this account, I own 200 shares of Palantir, so I am able to write 2 options contracts. This doesn't represent my full position on Palantir, and so this wouldn't represent a complete closeout in the position. So for writing this options contract, I will get $425 times 2, so I'll get $850 for this total contract. That's a decent upside, and yeah, I'd be willing to part with my Palantir stock for $850. That's okay. So again, right before you hit the order, I'm selling 2 calls to open with the strike price of $95 expiring March 14th. This is expected to give me a credit of $870, and the trade has a 66% chance of being out of the money. Which, that's no one knows the future. That's what's so hard about this game. And then it says, if assigned at any time, you will have the obligation to sell Palantir at the strike price of $95. Assigned basically means the buyer has exercised the call option. So, all right, I just went through and fulfilled the order. I ended up doing it off the ask price, so it's $4.35 for the contract. So I netted about $888 from this. So just some final things before we close out. So is this risky? Well, if you don't mind selling the stock, which I don't mind selling some of my Palantir stock right now, it's really not that risky. Actually, covered calls are one of the least risky option strategy since you already own the shares. And then why would anyone buy the call from me? Well, option buyers are speculating on a big move. And while they're speculating on that big move, I'm happy to collect the steady income and potentially sell my shares. And then what happens if Palantir crashes? Well, I'll take the same losses as a regular shareholder, but at least I get to keep the premium, so that cushions the downside a little bit. But all in all, where I'm at with my thesis on Palantir right now, I think the stock is trading at a very, very high valuation. I know it is. I mean, its PE ratio is almost 100. And so I'm happy to start closing out the position, but I'm definitely not in a rush to do it. So that's why I'm using this strategy of selling covered calls right now. That's all for this one. If you'd like to learn more about what we're all about at Flank Investing, you can find a link in the description below, as well as a link to our free Discord. I really hope to see you there. And if you want to check out that video explaining what options were in general, you'll see that over my shoulder now. The video did a really good job of explaining what options were in a general sense, but then also framing it in real world news, the actual options contracts that Nancy Pelosi is buying. Thanks again. We'll see you in the next one.